Finally, it's the start of the pullback that we've all been waiting for, or at least maybe just I've been waiting for. But jokes aside, there is reason to believe that this market could continue in the downward direction based on concrete evidence over in the S&P Sectors. We'll cover all of that and more in today's episode of the Midweek Market Update. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on our zoomed-in SPY daily time frame chart, what do we see from a trend perspective? Still certainly in an overall uptrend here, but I would understand that if you wanted to call this a little bit more of a neutral trend or just a simple balance area, that would be well understood. We did basically produce an equal high for all intents and purposes and mostly equal lows at the bottom of today's range. If you wanted to get really granular with me, really nuanced, yes, technically speaking, this is a lower high, and yes, technically speaking, this is a higher low, and we have range compression. But if we're counting the overall trend, we're coming from lows, higher lows, because we did technically flip into an hourly downtrend here, although it was very short-lived, and along the way we have highs, higher highs, and we are pulling back or really balancing from the last higher high. So balanced to slightly up on the daily time frame chart. We know that the weekly trend is up, monthly trend is up, but let's discuss what's been going on here because there are multiple failures from the buyers over and over and over again. This is a change in character for our market. In the past, right, CPI, and even before that, we were just getting gap and go, gap and go. That was the pattern of the market. We got a gap up last Wednesday, and that failed to produce any gap and go, and instead faded back more meaningfully into the overall balance range from here. We also got a breakout on the Friday session there. It didn't materialize in much. It did technically close over that Wednesday high, so it validated the breakout. But notice that on Monday's session of this week, we test the bottom end of the range. We just barely close at the top of the balance here at 456.30. Tuesday, the upper wick shows some struggle at the top of the balance range, and today's Wednesday gap up that has faded all the way back down to the bottom of the balance range here is really a monumental failure from our buyers. We'll look at that from a more nuanced perspective on the hourly in just a second, but on the daily chart, any breakdowns underneath 453.90, I mean, you have to imagine that this market at least, at minimum, pulls back to here to give a test of 451.10. Now, be cautious when we get to 451.10 because we know off to our left, although we can't see it from this view, we do have weekly structure, and it is possible to find a weekly higher low at this potential area. So just keep an open mind to buyers showing up at 451.10, but if there's a move through that, a blatant disrespect, no buyers at 451.10, the next big area to be thinking about is the top of the CPI gap here at 446.15. We know that this unlocks the single prints to get us to that in the first place at 448.10. Now you might be saying, well, Matt, yeah, that's technically on the table, but it's a huge violation of the lower edge of the expected move. That would be like a 2-3 sigma move in the downward direction. And you're absolutely right, but please remember the concept that markets move from periods of balance to periods of excess. If this is a period of balance, it wouldn't be shocking to see some excess around the corner. And if it's in the downward direction based on a breakdown of 453.90, we have to lose that area, right? We have to bring in a daily lower low underneath the last higher low in the overall sequence. If that happens, we could get some excess and you could see some of these lower targets, even if it means an extension through the lower edge of the expected move. Remember, as we were on the ascent here, the market did an awful job of pricing in risk, and we were consistently breaking the upper edge of the expected move. There's nothing saying that we need to hold this area. It's just a suggestion from the overall options market. If there is a turnaround Thursday and a rally into Friday, obviously you're looking back at the equal highs, and anything beyond that, we could at least consider 461.75. Let's move on down to the hourly time frame chart to really dissect the price action, get granular here, and understand how important the failure of the buyers was on today's session. So if we're remembering this as the original range here, this was a failure. There was no attempt for a higher low outside of the range here. As a matter of fact, we actually produced a lower high inside of the balance range and kicked off that hourly downtrend. Friday's impressive. We'll give credit where credit is due. The buyers clearly took price with momentum out of the range and hit the previous structure. But on Monday's session, notice that the buyers fail at the top of the range. They fail into the afternoon at the top of the range and just hardly make it for close barely up above into the 4 p.m. bell, right? But notice here that there is a very nuanced higher low and then higher low even here into the end of the day's session. So buyers are trying to fight back after moving in inside of the balance range, and I would even give more credit to the buyers on the Tuesday session. Notice that if this is the afternoon consolidation on Monday, Tuesday we open underneath that afternoon consolidation. If that's going to act as overhead supply, it should be easier to weigh on price in the downward direction. Instead, the buyers really respond with yet again another break up and over the top of the balance range, but notice that these are just upper wicks. We never actually close firm hourly bars. There is no hourly high or low over 456.30. It's just upper wicks, tests, and consolidation into the afternoon without firmly breaking that. So, okay, let's continue to play out the story. We have lows, higher lows, technically higher lows here. We're trying to fight back to the equal high. Wednesday's gap up is a massive gift to the buyers. They've proven themselves with some subtle strength in here, and now we have the equal high. We finally have the opportunity for a higher low outside of 456.30. Well, lo and behold, when we come in for the gap close, there is no response from the buyers. Okay, then it's got to be the top of the range, right? You can finally see in here a very, very small hourly hammer candle, indicating that the buyers are at least stepping up in this congestion. There's still an opportunity for a very nuanced higher low. It's got to hold, right? The buyers are trying to put up this fight. They're trying to get us back out of the range. It just simply doesn't happen. And instead, we break down to a lower low underneath Tuesday's low of day into the afternoon and even close underneath that level here. So again, just an absolute utter failure from the buyers in this market. If we take out the anchored view apps, you'll also start to overlay a little bit of confluence here, right? Actually, it's more than just a little bit. Notice that the triple threat band at the top would have been a higher low outside of 456.30. No response from the buyers. You get this as a little bit of double trouble in here at the lows of the Tuesday consolidation. No response from the buyers as we slice through it into the close of the day's session. Now, your last chance is at the bottom of the overall range, but after 1, 2, 3, 4 failed moves up and over 456.30, I wouldn't become too much of a buyer or an aggressive long off of 453.90. You do have your anchored view app there, but there's clear evidence that the sellers are gaining control. They're building control in this market. The character of this market has changed. We're no longer just seeing gap and go, buyers totally dominating a one-sided market. So how do we want to see this unfold into the end of this week? There's a couple of different paths that I would pay a lot of attention to. If you're a bear, what you're looking for is a lower high to continue the bearish pressure underneath 456.30 and then a flush of our daily level here at 453.90. If that breaks down, all of this turns into overhead supply, weighing on price in the downward direction. So what it looks like is this, and then so you can get a short here on a lower high. If you can pick off that reversal, you could look for a breakdown through the bottom end of the range, or if you're someone who likes a little bit more confirmation, you could look for a lower high underneath 453.90. Remember that when and if we approach 451.10, be open to the idea of a possible weekly higher low, but if there is no sign of buyers whatsoever showing up at this level, your next target underneath is at 448.10, and remember, we can see some excess after a period of balance up here. That's the bearish pathing and bearish inflection points that I would pay most attention to. Lower highs underneath 456.30 or a breakdown underneath 453.90. If you're a buyer at this point in time, there's no ifs, ands, or buts about it. There's only two things you can participate in. Number one would be a breakback through the top of the range with a confirmed hourly higher low. Remember, failure number 1, failure number 2, failure number 3, failure number 4. We have yet to produce a higher low over 456.30, so don't get your hopes up here on the hourly time frame chart. But if we do, yes, I would concede that we are trying to fight back to the equal high. The target is 459. The other bullish trade that could possibly unfold, and you will have to be quick draw McGraw to pull it off, is a fake break underneath and then a higher low back within range. You are not a higher low, or excuse me, you're not a buyer here until you actually get the higher low. That's what I was looking for at 453.90. If you can get a look below and fail, the target is technically the top of the range. Now, what's the concern with this setup? Technically speaking, you've just violated the bottom. You've produced a lower low. It's very reasonable that the daily time frame chart could look for a lower high at 456.30. With all of that said, let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, you can see that Tuesday is the day that we want to focus on. We did have substantial outflows from the market on the individual session, getting underneath negative 300 million. Net flows on the week are at negative 348 million. Not yet substantial there. Net flows want to be positive or negative 500 million, but very, very close. There's still 2 days left in the week, obviously. Tuesday, we do have substantial advanced decline line activity at or around the negative 1,000 mark. Today is over the zero line, but of course fading towards the zero line throughout the duration of the day's session. And if we look at the cumulative tick, really not all that bad on the Tuesday session, but let's focus on the volume flows for just a second, right? What does that mean? It means much more volume is flowing into down stocks than it is up stocks. So you can make a conclusion that there are a lot of shorts initiating in the market. If you take a look at the Tuesday session on the ES, that's this consolidation here as the day wears on and the outflows become substantial. As we open up on a gap up this morning, it would lead you to believe that everybody who is net short from the Tuesday session here is underwater, and therefore it would be easier for shorts to close out, adding buying pressure to the market. That was clearly not the case, and you can see how the internals flipped from a bullish open up here, and here to a bearish close. Substantial cumulative build in the downward direction. We did close volume flows negative, and the advanced decline line made the move to the zero line. So if there was an opportunity for continuation, it would have made sense on this morning's gap up. It simply did not happen. This is yet again another illustration of the failure from the buyers in this market. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. What do we notice from a value area and point of control perspective? Here is Monday value and point of control. Tuesday value and point of control basically unchanged. Here is Wednesday's value, but notice the point of control virtually unchanged. So as this market has tried to make a step in the upward direction, it's not really being confirmed by any volume commitment at some substantially higher prices. Now there's two ways to think about this. Well, number one, longs are building a position from a better trade location. When the breakout happens, it'll be more difficult to turn them into overhead supply. Number two is that just nobody wants to transact up here. And if nobody wants to transact at the highs, it's going to be difficult to push the market even higher and produce a higher high in the daily trend count. So if that's the case, then the idea would be to break down through the mechanical lows. Notice how Monday and Tuesday have extremely similar lows. If we break down through that, we're really looking to open the door there for our daily pullback to unfold, and that's been the case that we've built on the SPY daily, hourly, and even with the market internals. You would be turning this balance and value area and point of control into overhead supply as you would the entire range on the hourly time frame chart that we've been discussing. There's a little bit of a spike into the close of today's session. You can see that M period here produces that spike. Spike rules will be in play. If we open under the spike on a technically gap down, the market should auction lower. This is overhead supply. We're breaking a key daily balance area. I would look for a gap and go in the downward direction. If we open in the spike, that's just this little section right here, the M period lows, I would look for two-sided trade. Breaking the lows obviously opens the door. If we move further into the range, not the end of the world. You could still look for value area low rejections. You could look for lower highs to be set, but it wouldn't be as bearish out of the gates. The thing that would negate the prices at the lows of the spike would be an open, I would argue, probably up and over the single prints from L period here at 45.64. If we can open above that, then these shorts got a little bit ahead of themselves into the close. We might get some more balance through this range as those shorts close out and the market looks for the next thing. The next catalyst could be the jobs report coming on Friday, right? Looks for the next thing to make its next move. But overall, the lack of value, the lack of price acceptance near these highs does strike me as a more bearish than bullish indication. So shifting gears to the QQQ daily time frame chart, we're actually going to see a whole lot of the same with a little bit of relative weakness as compared to the S&P. Obviously, if we're thinking about trend, we have a budding downtrend in the QQQ with a daily lower high being set here. We know that this was the low of the hourly downtrend, and of course on Monday we produced a lower low. So we're definitely in a QQQ daily downtrend, relative weakness to the S&P. You can see clearly that we did not get a gap and go. We didn't even test the top of the upper balance range. This would be your upper, and this of course would be your lower. So no gap and go. In addition, we did not get a gap fill reversal, no higher low inside of the upper range here. So just like the S&Ps, a big monumental failure from our buyers, but we shouldn't have been as surprised because the NASDAQ has had the relative weakness for a little while, making that lower low on the Monday session, testing and even dipping a toe into the CPI gap. Obviously, if there's continuation underneath 383.25, the CPI gap close is the main focus here into 378.25, and when and if that happens, we should be open to the idea of a weekly higher low, right? Because we're changing the tone of the daily chart for a pullback here, we don't want to lose sort of the context of what we've been hoping for. We've been asking for a pullback to set a weekly higher low to make this uptrend more sustainable. So don't lose sight of that. We're still looking for the buyers to show back up after a reasonable daily pullback, which of course requires a daily downtrend downtrend in the first place. So 383.25 is your key inflection point. If the buyers are going to make more progress on the daily, you really need to get more price acceptance over 387.25. Let's jump on down to the hourly time frame chart here and dissect the price action just like we did the S&P. You can already see the relative weakness with the lower low in relationship to the lows of last week on the Monday session. The buyers did do a good job on Tuesday. Again, a little bit of credit where credit is due, trying to build an hourly uptrend here with a higher low and breaking to some higher highs this morning. Again, an utter failure from the buyers to produce a higher low here. There was just nothing at the bottom of the upper range from there, and we obviously moved underneath the afternoon consolidation from the Tuesday session. We did not, though, take out the Tuesday low of day. So that is an interesting little nuance, but nonetheless, it still leaves the bears in control on the hourly. We can throw on the anchored view apps here as well, and what you'll notice out of the Qs, and again, with the relative weakness, this shouldn't come as much of a surprise, we're underneath all four. This is double trouble stacked up as one in almost the same, your anchored view app from here and here, but we're underneath all four as opposed to still holding on to hope that the lowest anchored view app from the CPI gap up could produce support at the bottom of the range. It's simply not the case. So as we walk forward, the bears, of course, want a lower high underneath 387.25, something that continues the downtrend like this. Highs, lower highs, technically equal / very nuanced lower highs, hourly lower high here, and then an equal low reattempt opens the door for the CPI gap close, or very simply put, consolidation underneath 386. Look for equal low breakdowns below 383.25. If you're looking for confirmation, you could, of course, wait for a lower high set inside of the CPI gap range underneath 383.25. Those are the bearish plays in the downward direction. We are technically getting a little bit of a daily Man Ray pattern. We will coin that one as a Trade Brigade original, and that would, of course, act as your neckline into the CPI gap. If the bulls are going to try to recover here, first and foremost, you need an hourly higher low back above 387.25 to get more price acceptance in the upper range. Looks unlikely based on what happened here. Mid-morning, there was clearly a rejection of the anchored view app cluster. No higher low was set there. The buyers didn't really respond whatsoever. So I'm not holding my breath for that situation, but it would be a good first step that would start to get your NASDAQ a little bit more neutral through here. Remember, there's relative weakness. So the only time that the buyers really gain back their edge is on a break and higher low up and over 391.15, which based on the price action in front of us seems like a little bit of a stretch here, considering we just haven't seen any strong buyers at all throughout the duration of this week. Let's jump on over to the market internals, and I think that this would really confirm Monday's session pretty lackluster in terms of volume inflows. I will concede that the bears didn't have as much of an edge here in the NASDAQ on Tuesday. The damage was done with that Monday open underneath the upper balance range that we just saw on the hourly, right? So Tuesday didn't have to get all the way here to bring in that lower low. Obviously, that happened on Monday, but the same idea with volume outflows on Tuesday, more of a bearish advanced decline line on Tuesday. You can see that your cumulative build was much more bearish on Tuesday as well. If the shorts were going to squeeze, if the buyers had any opportunity to sort of build an edge in this market, it would have been on today's Wednesday gap up, and it simply did not happen. So still looking at that through the lens of a failure for our NASDAQ internals. If we take a look at the market profile for the NQ, you are getting a little bit more of stair-stepping with your value area happening like this, but notice that the point of control, again, here is Monday. We are technically above it, but we're underneath the Tuesday point of control. Value did not shift higher in today's overall range, and one thing that I would point out as well is that this A period did not have any B period overlap. So what does that tell you? Number one, it's a very emotional response. Any single prints that you ever see in a market profile mean an emotional response, but if it's A period, it means directly on the open. That's just outright liquidation. So buyers were like, oh my goodness, we're trapped down here, or oh my goodness, we're trapped from previous weekly ranges, right? Let's just sell this thing at break even as soon as the market opens up. So very, very weak-handed buyers is what I would take away from those A period single prints. We do have a very minor spike at the lows. Technically, you could just consider this, meaningful excess. We don't have a poor low, obviously. We do, though, have lack of material excess here from the Monday session. If we do continue in the downward direction, Monday's low would become a target. And then, of course, we're looking into the CPI gap below. And last but not least for the broad market, we have IWM Russell 2000 and the small caps daily time frame chart. What do we see here from a trend perspective? Once again, we're going to switch it up on you with lows, higher lows, and along the way, highs, higher highs, higher highs. You could technically count these as higher lows. We have flipped into an hourly balance up here, but the chart is very, very straightforward in my eyes. We do have an uptrend. We are sitting and just produced a brand new higher high on today's session. We did, in fact, produce a bearish engulfer. You can see the upper wick makes that higher high. And then we closed at or even slightly underneath the lows of the previous 2 days session. So a bearish engulfer with an upper wick as an inverted hammer really leaves a pretty clear path walking forward. If you were to break down underneath the lows of this, you could easily turn it into overhead supply, and we're looking for a pullback. But again, what's the idea here? We've just made a higher high. We're in an overall uptrend. There's a strong opportunity for a daily higher low around 181, the top of the breakout range from over here, daily 200 SMA, as well as the lower edge of this week's expected move. So I'd be watching very closely 184 and 181 here on the daily time frame chart. That setup is quite clear. Let's take a look at the hourly intraday session, and we'll just examine the price action a little bit. Notice this morning we did not open on a gap up. Obviously, the Monday session did not really produce a failure like what we saw over in the S&P and the NASDAQ, and instead broke for day 2 continuation. This was a concept we discussed in the weekend update from Saturday. Tuesday is a little bit of an inside day consolidation there, right? But again, notice that we open inside of range on today's session, and we break to that higher high from an open inside of range. That leads me to believe that there are definitely momentum buyers who are trapped at the highs in here. This is different than a gap up like what we saw in the S&P and the NASDAQ. So if we are going to turn this, as we can all clearly agree, into a double top, you need to break down through the neckline, which would be at 184. If we can flush that, of course, look left, there's thin structure until you come into that daily support, which we were talking about at 181, with confluence, daily 200 SMA, as well as the lower edge of this week's expected move. So if the bears are going to take a foothold into the end of the week, 184 is your watch. You can look for breakdowns, and you could look for lower highs subsequently underneath 185.40. That's your little lower high here intraday from Tuesday, and the open from today's session. A lower high from here to here sets up sort of a descending triangle, if you will, and then we will look for an equal low reattempt in short proximity of time. Door is open, and once again, thin structure from the Friday breakout of last week, but don't overstay your welcome on the short side. We know that there's the opportunity for a daily higher low at 181, the retest of your prior highs from here, as well as in here. So we're quite clear on the downside. Obviously, if we're just going to consolidate up here at the highs, you would look for a hold of 184. It's possible that you could get the same concept as the S&P with a look below and fail under that neckline, higher low back above. Then I would really want to see, to really gain confidence in this as consolidation, clear the midpoint there at 185.40. Anything that starts chopping around in here, build some confidence that this is turning into nothing more than just a daily bull flag, and then we'll look for continuation over time up and over 187.75. Let's say that for some reason, again, there's a turnaround Thursday and follow through Friday, your next upper target is up here around 190.10. What else can we see? Let's go ahead and throw on those anchored view apps, see what they have for us today, and I think that they are just beautiful confluence. 184, lower highs underneath, and your cluster is sort of in this range of the 181 down below, so that's all making some decent sense underneath us. Let's go ahead and grab a Fibonacci from the low of the Friday session of last week up to the highs, and lo and behold, your 38.2, you literally can't make this stuff up, is also confluence at that 184. So if it breaks down, yeah, we'd be losing high and tight bull flag consolidation, and you could look for that 181. 181 would be a dipping toe underneath the 61.8 Fibonacci. Not the end of the world, because in my eyes, structure always sort of takes over Fibonacci's. Fibonacci's are nice when they provide confluence, but they should not be an end-all be-all. I would really be thinking about that 181 as a line in the sand on the daily time frame chart. So pullback, totally reasonable here. And if the small caps pull back along with a breakdown of the NASDAQ into the CPI gap, it's a recipe for the S&P, of course, continuing to follow suit in the downward direction. Is it going to change the trend here of the small caps? Not really. And we still have them as a back pocket idea as broadening the nature of the overall market rally. If something like this starts to happen into the future, I wouldn't really say that the S&P is like, oh my God, it's the end of the world. The trend has to come to a grinding halt if small caps are playing catch up and being constructive with that higher low. Let's jump on over to the market internals for the Russell side of things. What you'll notice is substantial outflows on the Tuesday session where we got that inside bar. On today's session, we did get a little bit of that squeeze early on. So that's what it should have looked like over on the S&P and the NASDAQ if we were going to squeeze some shorts. It just simply didn't happen over there, which speaks to the lack of buying pressure. I would look at your cumulative tick here here on the Wednesday session as being substantial because it reverses all of the progress that was made in the upward direction here. Remember that IWM did not gap up and out of Tuesday's range. We opened in range and saw a breakout first before unwinding the move. The fact that the cumulative build could get this negative after a morning breakout does strike me as a substantial bearish data point. So breaking down underneath that double top neckline does seem to be a top priority into the end of this week. Here is the market profile for the Russell side of the futures. You'll notice this is Monday. You can see overhead supply, no acceptance on Tuesday, no acceptance on today's session. Point of control slammed lower here, and certainly in this very minor lower distribution. L period technically separates today's Wednesday session into a double distribution. We will be much more bearish if the small caps can remain in the futures underneath 1866. If we're under 1866, that's the equivalent of your lower high that we had just discussed over on the cash market. Let's just go back over here. That would be a lower high underneath 185.40, right? So any consolidation in there, staying under the single prints or underneath the upper distribution, we should say, continues to increase the odds that you're looking for a breakdown underneath the 184, and over in the futures, that would be underneath our 1853. So let's take a look behind the curtain at the performance of our S&P sectors. We're going to start by filtering by the daily performance. That's today's performance when we saw the red bearish engulfer in the S&P. Leading the pack, the only green name here is the utility sector. And as we know, those are D for defensive and they are lightweight. So as the market's pulling back to see those outperforming, doesn't really strike me as the end of the world. Remember that we become more skeptical about market rallies when they're led by defensive sectors and lightweight sectors. That's not the case. So to see them up while we get a pullback, not the end of the world. But who's leading in the downward direction? It's none other than your XLK, the tech sector, the heaviest weight sector that we have, the most risk on sector that we have. Same thing with the XLF. It is the third heaviest weighted sector and also a more risk on sector. Both of those names really led the downside from a performance perspective. And I do think based on the structural charts, we can see continued downside, which is one of the main reasons, along with everything we've discussed so far, I think we can see continuation out of the index as a whole. Let's go ahead and check in on those structural charts though, and actually see what's going on. So again, any issues with leadership here out of utilities? We know it's been the case for a long time now. No issues. We're just back at the beginning of the origin of the nasty breakdown from here in early October. So not concerned with that chart. Here's the XLK. And again, is there any concern here about the structure of the chart? The answer is no. It technically led to the downside percentage-wise. It had a bearish day. It failed the gap up, absolutely. But remember, we have this upper consolidation. If we pull back, we're still looking for a higher low. So is it reasonable that the XLK could see a pullback if we can break down from this as a distribution range, a balance range overhead, turn it into overhead supply? Absolutely. But again, does it mean that we're just, bearish the market? We've got to go to zero. This market rally is, it's going to be a failure. New lows incoming? Absolutely not. There's still an opportunity for a higher low at 178.75 and also here at the top of the previous range, 175.70. We've been asking for a healthy pullback and now it's time that we get our wish granted. And if this happens, we have to be prepared for it, right? So watching those downside levels and to me, turning this into overhead supply could be one of the main reasons that the market continues in the downward direction. While we're talking about tech, let's jump on over to the SMH and see what's going on with semis. They've already moved underneath the bottom of this balance, and that should make sense based on what we saw over in the QQQ. We already have a downtrend there. We have a downtrend here in the semiconductors as well. Continuing this breakdown underneath 157.60, the door is open through this thin structure for a weekly higher low, somewhere near the daily 50 SMA and weekly structure from back here at 152.25. So again, is it reasonable that after a move like this, we could experience a minor give back and still remain bullish in an uptrend? The answer is yes, until proven otherwise, with some sort of weekly deterioration back into a downtrend. As of right now, we simply do not have that, and this is a pullback until proven otherwise. Let's jump back on over to the S&P sectors. XLF, again, any issues? Not really. We're coming from the highest highs of this as an overall one-sided move. Is it reasonable that the market finally starts to produce some two-sided trade? Absolutely. If this is going to fail as a balance range, you're looking for continuation tomorrow underneath 35.70. Notice that we have thin structure until we come back down towards 35. One of the additional trade ideas today will be from the financial sector. Here comes real estate, rate sensitive, right? Ripping in the upward direction. It has not taken out this prior high. We're still technically near the top of this balance range, but again, upward pressure, a minor pullback here because it's such a lightweight sector, roughly 2.5% of the S&P. It's not going to really be the one that has pulled to the downside. It's going to be your XLK. It's going to be your XLF. Here's energy. We've been talking about, the global demand destruction for oil and the possibility of like a global recession. We've talked about China quite a bit, and this broke down from a balance range. What do we know about balance ranges? Typically, when they break, we look for a double as a first target. If we can get back down underneath the top of this as a previous range, that is downward pressure for the S&P. Again, a lightweight sector, only about, I think it's still around the range of 2.5%, maybe 3% of the S&P. It's been a week since we checked in, but these numbers are not top of mind. You understand the point though, right? If this is downside pressure, it's downside pressure, not going to make or break. Still XLK, still XLF. Continuing along, maybe we'll speed it up a little bit through some of the other sectors now that we get the main point across. Here's the XLC pulling back. Netflix has been a contributor over here. Can we find a higher low over the top of 68.10? That is your big watch. You are going to start to get confluence with your daily 50 SMA over time. Not the end of the world. The pullback that we have been asking for. Here's the XLB materials, extremely lightweight sector, the lightest weight sector of the S&P. Not concerned. Anything that's a higher low over this, great. Still looking to be bullish on the market overall, but again, not really a contributing factor. Here's the XLY, definitely more of a contributing factor. And what do we see over here? I mean, certainly in an uptrend, just broke to a higher high. Not even threatening a rotation close to the CPI gap range. Certainly the opportunity for a higher low here over 169. So, I think that these two could outweigh the XLK and produce the XLY, my apologies, and produce the pullback, but overall structure across the entirety of the sectors is not jeopardized to the point where we're saying that the market's going to collapse. We need to go to zero, right? XLV, again, pulling back off of a structural element, a possibility here, but even so, it's relatively strong. And again, we'll have a healthcare name in the lineup for trade ideas as a bullish trade setup, right? So as of right now, this doesn't strike me as an issue. It's the second heaviest weighted sector by market cap. It's D for defensive. We don't want it breaking out, leading, making new all-time highs, and it's not. But it's also not falling off of a cliff. Not an issue. Moving along, XLP. Back to the origin, very same comments as the utility sector. Here's the XLI industrials. There's your all-time high, bull flag consolidation. Sure, we made a higher high, came back into range. If we do break down, not the end of the world. We're looking for a very similar setup actually to what we have over in the IWM. A breakdown through the bottom end of the flag range, pulls back, finds a daily higher low. Then we look for trend continuation. It would actually add a sustainable component to this as an overall rally. Sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. What do we see? XLK continues to stay high and tight. It is getting a little bit of a rollover look here. That shouldn't come as a surprise considering that we just saw the Qs were relatively weak to the S&P. Is it aggressively breaking down? Are we through a downward sloping 50 SMA? Are we in a downtrend? The answer is no. So it's very difficult to say that this is a risk off indication. It still looks fairly healthy in my opinion. If we look at the XLV, it is creeping in the upward direction, but again, it's underneath a descending 50 SMA. So risk off is not the primary look here. XLF breaking out over that flat top and getting a mild pullback here. Welcome. Looks good to me. That is a risk on indication. And your XLY, as we just saw, had some decent relative strength, continues to outperform here. So as this continues to push in the upward direction, certainly looks more so like a risk on rotation to me as opposed to a risk off rotation to me. If you look at the XLP, it's still underneath a descending 50 SMA. XLU is starting to perk up here a little bit, but I would argue that it's not really going to do much in the face of an XLF that looks like this, in the face of an XLY that looks like this, and an XLK that is still hanging high and tight. Let's take a look at what we have out of some specialized ratios. XLK SHY, those are government-backed bonds. Notice that the consolidation is still over the top of your previous highest high, still an opportunity for a higher low. Even if we pulled back to tag the 50 SMA, found a higher low and moved away from it, that is a bullish and risk-on indication. Not much change over here. Similar comments out of the XLK over the XLU. We broke to a higher high. We get this consolidation. Remember that this is almost a rinse and repeat of this and this. Can we tag the 50 SMA and move away from it? That would be the next major watch. Because the XLK looks like it may want to break down from the balance range, I wouldn't be surprised to see a little bit of an overshoot here through the 50 SMA if utilities even just go down at a lesser rate than technology into the end of this week. So giving this one a little bit of breathing room around the 50 SMA, I would really want to see to flip more bearish on this ratio, you would want to see a downtrend, right? And we just simply do not have a downtrend yet in the grand scheme of things. Let's move along and take a look at apples to apples. This is a risk on indication, no doubt about it. We're finally getting much more time spent over the top of the range. Remember fake break 1, fake break 2. We also had a look below and fail. Now that we're spending more time above, that does strike me as an apples to apples, much more bullish indication here. That is risk on. Let's take a look at the dollar. What's going on with our Dixie? You can see we're getting a little bit of a rebound here as the market's seeing some downside pressure. Does that relationship make sense? Absolutely it does. Does it make sense with what's going on with gold? The conniving, heartbreaking gold. Let's move on over to gold. Oh my goodness, the squeeze on the Sunday night open, something, really for the history books here. But metals, I've said this in the past, I don't know in what video, you can go back, you can actually watch all of them and leave a thumbs up while you're there, but you can go back, and we always refer to the metals as the heartbreaker trade, and this was absolutely a heartbreaker. Now, what is it doing from a trend perspective? We just broke to a higher high. Is it possible that you could get a higher low over the breakout point at 2000? Absolutely. So from a trend point of view, this is still looking good for the buyers to be in control and thus continue to put some downward pressure on what's happening over in the dollar. So still thinking about the dollar with an opportunity for a lower high underneath the top of the overall range, right? That would be here. If we do continue, lower high like that is in the cards. Let's take a look at silver briefly, because this one actually didn't squeeze as aggressively over the highest highs that it made. It just rejected those highest highs. Silver has seemingly been a precursor for gold recently. It broke out earlier and it rejected at a structurally relevant place. If you're interested in metals, I would use silver as your sort of gauge to figure out what gold is likely to hold or not hold as we move forward. Let's take a look at some interest rates here and figure out what the 10-year is doing. Certainly breaking down more aggressively day by day underneath the big 43.33 inflection point. And for those of you who like to trade bonds or notes, as we call them, you can see that we have broken out over the inverted head and shoulders neckline. We've talked about this for quite some time. The reason I bring it up today is it's probably easier to look at through the lens of a long, right? If you do something like this out of the notes, you're still technically looking for a lower 10-year interest rate, which of course would propel, or in theory propel, the market in the upward direction. So this would be bearish. That would align with a pullback, right? These kind of move inverse, right? And then if we move back in the upward direction, or excuse me, these don't move inverse, rates move inverse, right? And then this would move back in the upward direction after that pullback is complete. So in sync, break, right, higher low here, that would certainly be helpful for notes. Let's take a look through the lens of the inverted ZT. What are the expectations from Powell? We'll get to the tracker tool in a second. Lower, which means that we are expecting cuts. Has anything changed with the tracker tool? Let's take a look now. Still looking fairly similar to the last check-in here, with 2 more episodes of a pause and then looking for a cut. But notice that instead of going cut back to back, we are getting a little bit of a pause now here into the May timeframe, and that actually does strike me as a healthy indication. Remember that we want the Fed to move slowly here in the downward direction, not just start aggressively cutting rates, to the tune of like, here's 50 basis points, here's 75 basis points, trim it. That would be much more indication of a panic. If it's just a mild sort of slow cutting of rates, definitely just looking for a healthy rate for the Fed funds instead of being overly restrictive, which clearly the market is pricing in. We've hit restrictive, even though Jerome Powell continues to say we might even hike one more time. Well, good luck with that, because if we take a look at the way that the data has been coming in, notice that JOLTS job openings here was a massive miss from the expectation. The labor market continues to come into a, quote, better balance, to be politically correct here, as Powell would say. You can even see that the ADP non-farm preview came in far underneath our expectations, to the tune of, let's just use round numbers, 30,000 jobs, right? So the labor market should be the main focus, especially now that GDP is also slated to come in, far worse than what we had out of Q3. Now, when I say worse, it's just on a relative basis. It's certainly not negative. We're not looking for contraction, but look at the Atlanta Fed's estimates here, how they fell off of a cliff to get more in line with the trajectory from the blue chip consensus. Now, the Atlanta Fed is usually not wrong in their estimations. They were almost spot on for last, quarter's estimates there. So I'd be watching this quite closely. If the Fed is going to do something about slowing growth, it's going to come in the form of rate cuts, right? And also, they can use the guise of, hey, we're just sticking to our dual mandate of making sure that the labor market remains strong, ensuring maximum employment. We're going to cut rates for that reason, right? Even though, in their back pocket, they might be thinking, hey, this economy is slowing way faster than what we want. We want to avoid a hard landing, a recession, deep, dark, dirty. We just want to stay away from that. So Fed should be focused on the labor market. We will be very, very interested in how the numbers come out on Friday. Here's the earnings calendar. Hopefully you had your popcorn out and you were kicked back in the Eames Lounge for C3 and GameStop. Actually, both of them were mostly nothing burgers. C3AI is a little bit lower. We'll see how Dollar General reports into the open tomorrow. And the biggest mover on this entire list is Broadcom into the Thursday close, end of day there. After the market closes, they will report. They have the biggest impact on your S&P. Let's jump back on over to the platform here and really see what's going on from a risk appetite perspective. Notice the TLT actually broke the resistance trend line here, but not just sideways sideways through time, it actually saw an aggressive uptick over the past couple of days, as especially on today's session, the S&P was lower. So is this a flight to safety unfolding? I wouldn't really tend to think of it, even though we are breaking via price in the upward direction. I think it might coincide with a little bit of a pullback here, and you could see a risk-off, quote, period of the market, but I don't think it's dramatically changing the tone of what's already been established with this run right here. And the reason I would say something like that is because if we take a look at what's happening with bonds in relationship to themselves, we are just getting a higher confidence outlook for a longer time frame. That's what these downtrends here indicate after coming from fairly aggressive uptrends, right? This represents uncertainty. This represents more certainty in risk assets, and the longest duration risk asset is a growth stock, basically, right? Especially in relationship to fixed date bonds. So that's what that's telling us. We could also pair this with credit spreads, right? TLT ratio to the S&P is an issue when credit spreads are widening. And notice that these are tightening and tightening. That is a bullish indication. It doesn't really strike me as an issue seeing that TLT break the resistance trend line. Moving along to something like our HYG, high yield by itself over here, junk bonds, they're high and tight. We've totally got an ascending triangle, and the market's more so sideways. So a bullish divergence actually in the HYG over here on the small time frames, but let's be honest with ourselves, right? If we just kick these back to daily, yearly charts, right, here is the HYG on a relative basis. This is that same range. It's got a lot of catch up to play over here, so you could take this with a grain of salt. You could say that, okay, on a smaller time frame, a little bit of relative strength out of the HYG, but in reality, probably just trying to play catch up, right? If we take a look at what's happening with Bitcoin, the digital gold, this is looking like a risk on move breaking out of this flag. The contrarians would say, Matt, you're silly. Bitcoin breaking out is a signal that stocks should crash. This is a flight to safety. Bitcoin, it's the safest thing since gold. There's limited supply. It can only go to the moon. I'm just going to take this as a risk-on indication, considering everything I know about Bitcoin and how it actually acts in terms of risk-on and off. In terms of breadth, let's take a look at new highs versus lows. We're still positive out of this one. That is a bullish indication. So again, when we talk about bullish indications in risk appetite and breadth, it really supports the idea that this is still just a pullback until proven otherwise. We're looking for a pullback, not an outright crash. Here's the SPX A200R still over the 50% mark. That is in a healthy place. And if we take a look at the SPX A50R, this is pulling back from contrarian zone. So once again, does it make sense that this is healthy? We want more stocks over the 50 SMA if we're looking for bullish uptrends. But is it healthy to see a pullback and then just remain high and tight? Absolutely. And that would also coincide with a pullback in the S&P. So contrarian zone here might actually play out and give you a heads up for the pullback that would align with looking for a breakdown underneath our equal lows. Let's move along and take a look at equal weight, S&P 500. Notice that there's a strong opportunity for a higher low here. And again, don't get me wrong, we still have these major divergences from like here to here. But in the immediate term, this looks constructive to me. An opportunity for the RSP to hold 145.75 on a pullback, digest some of this move via price pullback, looks good to me. Looking for continuation over time. There's nothing really about this that's like, hey, big red flag, major issues for the marketplace. Not really the case, seeing what we have on the screen in front of us. Same story over here in the QQQE. Higher lows want to be above or at the bottom of the gap here, 76.65 or 74.45. How about transports over in the Dow? What you'll notice over here is a pullback already beginning to retest the neckline. I would really love to see 15,165 act as that line in the sand. I really don't want to see price underneath that in the transports. That would give me more confidence that any higher lows over here might tend to hold. If we do start to dip a toe into this range of the right shoulder, not the end of the world, but a nail in the coffin, certainly a lower high underneath 14700, that would be much more concerning over out of transports. So far, doesn't look like a big threat yet, but we'll keep an open mind into the end of the week. We'll have these things to be paying attention to. Let's move on over to volatility. We know that we have some issues here with the depth of the contango. VIX by itself, non-issue, suppressed, sitting on the lows. Not really surprised by that considering the market context. VVIX a little bit elevated here, might start to act as a precursor. Notice how this is creeping higher as we're consolidating. To me, that's an indication that people are basically not trusting the continuation of this rally. Even though the VIX remains low, the VVIX perking up a little bit means that there's more activity in the VIX, even if we can't see it based on immediate price. Same thing is the takeaway from the volatility futures. Really deep contango, as we talked about in the weekend update. This is so deep that it just illustrates a lack of trust for the future. At this point, if we just actually head on over to the trade tab, let's jump on over here to the VIX futures. Just want to walk through it with you. So 14 days, oops, let's get rid of that. We're pricing in a 1372. Even if you go out 21 days, you've got more than a point worth of value out of your VIX futures. If you want to go to the next active contract here, which would be the January expiration, 1552. More than like $1.50, right? So definitely not so trusting of that future. Think of it like this. Everybody's like cool right now, but hey, we really don't think that this market can sustain itself. Normal curve might look something like this, where we're just like, yeah, maybe there's more risks on the horizon. Right now, nobody really trusts the, looking out further. As you can see, like 21 days, 42 days, good luck if you start to go out from that type of duration. One thing that we can see is a small uptick out of 9 versus 30-day VIX. That's getting closer to a backwardation, although not all the way there yet. If we look at the one-day VIX, we're still underneath the overall range from the October panic, so this actually would be more so aligned with what we saw out of the VIX and the VVIX itself. It's not like we have present day, oh my god, world's ending, but if this were to perk up, over this, okay, maybe this starts to indicate that a pullback can unfold in the market. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Let me know down below in the comments section or by giving the video a very simple thumbs up, and rejoice in tonight's analysis because I'll be unable to produce tomorrow morning's episode of the pre-market prep. I, of course, will be traveling up in the sky somewhere. So with that, Apple's up first on the chopping block. We'll be back live on Friday, so don't you worry about that. We will have coffee and donuts for the jobs report, but Apple's up first. What do we see here? Break, retest, opportunity for a higher low over 192. If buyers start responding here at 192, Apple is going to act as a bullish anchor for the S&P. Don't get me wrong, the S&P can continue in the downward direction, especially if it breaks underneath its balance lows. But if Apple wants to consolidate up here, you're going to get much more of a muted reaction out of the S&Ps. Now, on the flip side of that coin, a breakdown underneath 192, you could look for like an immediate 5-minute break and retest underneath that low of day. You're going to be looking for an acceleration out of the S&P because this, of course, indicates a look above and a failure. The target should always be the opposing end of the balance. In this case, that would be 188. So Apple taking it at face value, watching this balance range, watching 192. If we're over, looking for healthy flag consolidation on the hourly. Continuation can target these upper levels, 196.75. Then the all-time high is right there. And then underneath, right, you could look for lower highs intraday under 192, flushes under 190.15, target 188. Next up, Microsoft. What's happening with Softy? Your higher low is trying to hold here on the daily time frame chart from a weekly perspective. I know that's kind of a mouthful, right? But this was your last major set of lows. Maybe these were higher lows as well. You've broken through those, but if you're going to find a weekly higher low at your previous all-time high, this is do or die, right? So we're still not underneath that level at 364.25. Unfortunately, though, we have highs, lower highs here, and if we trade back to the equal lows, it's kind of game on to, again, have much more of a rounded top, some sort of rejection up here. You could think of it as distribution. We're not holding that, and the danger is this thin structure underneath. So if this produces a lower high, whatever your flush is underneath the prior all-time high at 364.25, the door really opens up underneath 360.50 to target the daily 200 and your prior breakout point here. 347.50 is the number. The buyers have much more control if we can recapture 371. Here it is on the hourly time frame chart. Something to point out is that, just like the broad market as a whole, we had the opportunity after breaking above to find a higher low on today's session in particular. It didn't happen. Instead, it's a lower high into the afternoon underneath, and as we know, that technically sets up the continuation back to the equal low, and as we just discussed from the daily, continuation in the downward direction. So the buyers really only have something going on if we get higher low acceptance over that 371. Moving along, what do we see out of Google? GOOGL is the name. Let's go back to the daily chart to begin here, and what we'll notice is the same thing, right? These higher lows did not hold. This really didn't hold as a higher low opportunity on the daily or weekly, and now we're trading into this zone down here. So this is building out as a little bit of a balance, but what you'll notice is the same concept, the lack of price acceptance over that 131. Here it is back down on the hourly chart now that we can understand and see that. If this is a double top, right, technically we're underneath the neckline into the close. Any subsequent lower highs under 131, trade to this breakout point here at 129.25, and then through that, things get more dangerous into 127. You do have to contend with the lows of the Monday session here, and that's definitely something worth paying attention to, but I would really make the argument that your stronger daily level is going to come from 127. All right. Next up, let's move along to Amazon. What's going on with Nancy? Nancy could not hold up and over that 147. We were giving Amazon the benefit of the doubt. Here it is on the daily time frame chart, right? You can clearly see the difference between your Amazons of the world and your Google and your Microsoft of the world, where those were struggling, right, to find those daily higher lows. Amazon was trucking along trying to find higher lows. Unfortunately, this is a little bit of a break to a lower low. This is definitely a little bit more of a lower high on the daily. So again, if this is turning into distribution, your next big break is underneath 143.30 to target the equal lows from back here, 140.50, and you can walk down the targets from there. Here it is on the hourly time frame chart, and again, you can see lack of acceptance over the 147, even opening above after a bullish rally on yesterday's session. So I would say that the bears have the benefit of the doubt. Any continuation under that 143.30, is right here, and you can see the rotation through the prior structure that we had off to our left. NVIDIA, some news with some competition, right? Obviously, I think it was Apple saying they would buy AI chips. Was it Apple or was it Microsoft? One or the other, saying that they would buy AI chips from AMD and Intel, I believe. But regardless, the stock is lower after failing to hold a gap up over this as a major inflection point, right? If you were going to hold a weekly higher low, you wanted to be around this zone. Now, don't get me wrong, we have incremental higher lows at the 50 SMA on the bar-to-bar count here, but the bearish nature of today's bar, failing the gap up, all the same reasons we discussed in the S&P, leads me to believe that the bears have the upper hand. And again, our flush is under 450, break of the daily 50 SMA. Next target underneath is the neckline, if you will, of this very sloppy lower low double bottom here at 437.25. If there is going to be a turnaround Thursday, where do we need to recapture? Here it is on the hourly time frame chart. First step is a higher low over 461.25, and beyond that, I would become much more confident if we could get some moves over 468. This is a thin structure retracement. Bigger target is 476, coming from the breakdown point over here. Next up, we've got Metaverse. What's going on with Zuckerberg's Fantasyland and the ACL? It's looking fairly weak. The ACL is maybe re-tearing as he's laying in the hospital bed. A breakdown underneath 315.50 opens the door into 307.75, and remember that this is the godforsaken range out of Meta. We really don't want to travel back down towards here. We even had a level at the 317. The 317 has been made obsolete basically by this price action over here. Treat this as a very simple range, right? You can clearly see today we tried to get out of the lower distribution. This is the upper distribution. It failed. We have a lower high. We closed in the lower part. So what does that mean? If this is sort of like an at the lows double top, something that looks like this, break the equal lows, the neckline in this case, that's under 315.50, target 307.75. The only time the buyers have an edge is if we can consolidate here and then break higher low required because of the daily downtrend over 322.25. Next up, Tesla. What's going on with Mr. Musk? And I don't know if we want to call it the rocket ship, as it's just sideways in a range. Here it is on the daily, doing absolutely nothing. So like the broad market, remember that balance leads to expansion and expansion leads to balance. So if this is a balance range, a doubling in the upward direction gets you closer to 260. A doubling in the downward direction gets you much closer to 218.50, which is prior structure from way back over here. I would take this on a day-by-day basis and say, okay, are we accepting in the upper 50%? Are we accepting in the lower 50%? Over 246.25 with higher lows, great. Under 230.65 with lower highs, fantastic. Let's take a look at the hourly. You can start to see a little bit of nuance here. We had an opening range sort of up here at the highs. It failed into the close. That does strike me as a bearish indication, but again, in the grand scheme of the range, we're just in the middle third. If you wanted to break this into very rough thirds, obviously buyers built an edge back here, and we'll look for an equal high breakout. If we want to drift lower, we'll take it in stride and really call it for what it is. It's just a balance range until proven otherwise. Last but certainly not least, Netflix. The unspeakable has happened. The strongest trend that I've seen in a very long time, near vertical here, has finally produced a pullback, right? So broad market pullback, Netflix pullback, it's all good. If this breakdown wants to continue underneath 447.50, you can see the door is open. It's quite thin all the way down into 437 flat, so about 10 points of downside activity. I do think of Netflix as a big failure this morning, just like the broad market. If this was bear flag consolidation, especially in the context of this as a very, very strong daily uptrend, trend. Any shorts who were like overly aggressive as this pullback and gap down were unfolding should have gotten burned on the gap up outside of this balance range right here. Not the case. You get more profit taking, and we actually close a bearish engulfer, making a lower low. So it doesn't look like the pullback low is in yet. I would keep an open mind to further downside and continue to await a higher low on the daily time frame chart. An hourly trend reversal is required for that. You need to flip into an hourly uptrend. This was looking pretty good, right? Opportunity, just like the broad market, for a higher low here simply did not happen. We broke to that lower low, so keeping an open mind for downside first and being patient for the hourly trend reversal. Buckle up, we've got 5 trade ideas and then you are on your way. Go enjoy your dessert for the night. Costco is up first. Costco wholesale, ticker COST, 3-bar inside play, bullish 3-bar inside play after a break of these range highs. Complete relative strength to the broad market, possibly a pre-earnings run-up. Earnings are a little bit further out on this one, not a concern as of right now. Looking for a move up and over 608.25 for continuation into the all-time high at 612.27. If that does take place, we're in blue sky territories, whole and half dollars. I would honestly argue just whole dollars, $5 marks on something that's trading 600 plus at that point in time. After Costco, and by the way, this is in play as long as we hold 600 on any possible higher lows, right? Consolidation here keeps it in play. Watching for a break. Anything under 600, no longer interested. Next up, we have UNH, United Healthcare Group. Obviously, in the healthcare sector, we saw the relative strength out of the healthcare group, the sector, I should say. Perfect bull flag consolidation. Honestly, this could go in the history books as a textbook bull pennant here. If this breaks out, again, all-time highs are overhead and then blue sky territories. Whole dollars, half dollars, $5 marks. We're again dealing with a very expensive ticker here. The options market on both Costco and UNH, they're pretty liquid for high-price tickers, but still be mindful of the spread, especially if you're going to try to scalp them. This is in play as long as it's over 545, and the break is up and over 553.25, all-time high 558.10. You get the idea. Bullish trend here, looking for continuation in the upward direction. Next up, let's jump on over to the financial sector with none other than Mr. Demon's JP Morgan. What do we see over here? This is a bearish setup with a bearish engulfer. Sure, we're in an overall ripping uptrend, but we know that the bearish engulfer at the top of this move might signal that underneath the 2 equal lows from the Friday and then this Monday's session could open the door for a continuation of the pullback. The bearish engulfer represents momentum, and then we have a structural element that would lead to a retest of the breakout in the first place. Underneath 156, target 154.25. This is in play as long as the bearish engulfer is not retraced more than 50%. As long as we're in the lower 50%, looking for that to remain as a valid trade idea. That's JP Morgan. Here it is on the hourly chart just to show you the strength of the engulfer, right? There is hardly any hesitation at the consolidation lows of this, and we close very weak, spot on to the low of that Monday session. Let's move along and take a look at what we have next. AMD had an honorable mention from a chip making perspective as well, and a bearish engulfer here. It could not escape the fate of the positive news. You have incredibly equal lows building a flush point at 116.20, a little bit of, it's not really there. You wouldn't call this a very classic head and shoulders. Rounded top, perhaps, with this lower high from here to here, but nonetheless, bearish engulfer, large upper wick. It technically opened on a gap up, closed near the lows, right? Flat lows, flush point. Target would be here at 113, a retest of where this breakout really originated from. Anything underneath that, I would start thinking about an even deeper retracement into some of this thin structure, but we'll take it one day at a time. Let's not forget that it still is technically in a budding uptrend over here from a weekly perspective. So scalps, definitely overstay or welcome? Not yet, until there's a clear violation of 113. Next up, last but certainly not least, is going to be on Intel. If Thinkorswim wants to unfreeze, there we are. INTC is the ticker, and here we are. This is definitely a thin structure retracement play. We have the inside bar, classic little doji there on the Tuesday session. Open above, close underneath. Thin structure off to the left. The breakout origin is at 39. A cheaper ticker, definitely worth exploring the options chain over here, or just looking for shorts via shares if that's not your mojo. Plenty of liquidity over on Intel. Your breakdown is clear. Under 41.65, continued price acceptance underneath, looking for continuation in play, even if we rally for a lower high up against overhead supply here at 43.40. Here it is on the hourly time frame chart, so you can see it as clear as day. You could look at this through the lens of a double top. There's your neckline as long as we're below. In play to the downside. Ideally, though, from an hourly perspective as a scalper, right, you just want to see it underneath that 41.65. That's going to do it for today's episode of the midweek market update. Once again, I will not be live tomorrow morning for the pre-market prep. We will be in travel. And then on Friday, we will resume for the finale of the week and the labor market report. If you enjoyed the video, learned anything new, let me know in the comment section or by giving the video a thumbs up. I wish you all a green trading week, and I will see you in the next one.